Hi friends, this is my second multi-bagger workshop. The first one was released around a couple of weeks back, and I got a good response on that particular workshop. Friends, this is a standard disclaimer which we use that this particular pack is being created only for education purposes. Please do not treat this as an investment advice, right? And please perform your own research before investing your hard-earned money. And we will not be responsible in any ways in case you have some losses or profits if you do your investments based on this particular pack. So this is our stock selection criteria. The first one is that it should be a small cap company which has a potential to become a large cap company in the future. The company should be in a business which has a good future potential. The company should be a debt-free company with a good amount of promoter holding. The company should be in the business for a long time, right? And the important ratios like return on equity and return on capital employed should be good. In this particular workshop, we are releasing the name of the company right early in the early stages of the workshop. The name of the company is Savita Oil Technologies. The name of the company might not be that popular, but they have a very good branded product with the name Savsol, which you might have heard about it, right? As far as the company is concerned, it's a small cap company and it's into the business since 1960. The promoter holding is good, more than 70%. The FII and DII are also having good stake in the company. The combined figure is around 9.3%, and the promoters have not pledged any of their holdings. Here we are doing the comparison of this company based on two ratios, that is the PE ratio and the PB ratio. P is the price to EPS, and PB ratio is price to the book value. On both of the fronts, compared to its peers, the company is trading on a very low PE and PB ratios. The company is currently trading at a PE ratio of just 8.5, whereas its competitors like Linde India, Solar Industries, Deepak Nitrite are trading at PE ratio of 70, 45, 50, that kind of higher values. Similarly, the price to book value is just 1.54, right? And in comparison to its peers, the PB is quite low, right? As you can see in the slide. And also want to say that the company has been a consistent dividend payer, and the dividend yield is also pretty good as compared to its peers. Let us look at the company's business. What business company is doing? The company is primarily manufacturing different kind of oils like transformer oils, white and mineral oils, formulated and specialty products, automotive oils, and industrial oils. And a lot of big brands like HUL, Dabur, Marico, NTPC, BHEL, Crompton, Power Grid, Tata Power, Tata Motors, Hero Motors. These are the good branded clients to which this particular company cater to. Let us talk a little bit about the company's revenues. The company revenues come 20% from the exports business, while 80% of the revenues come from the local domestic market in India. And the company has a huge strong presence within India with around 400 distributors, 1500 franchisee dealers, and 20,000 retailers. The company has 4 plants in India, with the oldest one in 1969 and the most recent one in 2013. And also I would like to add that the company has various ISO certifications and government recognized Star Export House, National Safety Council, Maharashtra Ratna chapter, etc. Uh, Before we understand more about the company, it is very important to know about how the company is performing financially, right? On the different aspects like revenue, EBITDA, profit after tax, ROE, ROCE. On most of the fronts, the company has been performing really well, and it has been consistently performing really well. In financial 2023, you can see there was a slight decline in EBITDA and profit after tax. That is primarily because the cost of the input raw material has increased, right? Despite the little fall in the profit after tax, the company has still declared the dividend. So absolutely there is no issue. The long-term prospects still hold good for the company. A very standard question is like, why should we invest in this particular company, right? The first reason to invest is that the company is will be commissioning the new synthetic ester fluid plant, which will manufacture high performance fluids across product verticals. And as an additional information, these fluids will be manufactured for the first time in India. So it will be kind of a monopoly for this particular company as far as this product range is concerned. The company has a very healthy cash and cash equivalents of 51 crores as on March 2023. The company has been regularly innovating its product range and have been evolving with new and new products on a very regular basis. The company has a very good market share for most of its products, so there's absolutely no issues. The company is a very old brand name and it started its journey in 1961. So it's a very good brand name. So there should not be an issue as far as the investment in this particular company is concerned. Uh, I received a feedback in my first multi-bagger series that what should be the entry point for investment, right? So for that, but for finding out the entry point for investment, we should have a look at the charts and the supports, etc., which was not mentioned in the first multi-bagger series, right? So in this particular multi-baggers pack, we have included the last slide as the charts. The currently company is trading at the time of making this particular pack is around the currently trading at 280, right? And it has been consolidating in this particular range. I think that the company has a potential to go 4x 5x in next couple of years. It is already undervalued because it is trading at just a PE ratio of 8.5 compared to its peers, and it should give a good returns for the investors.